Joining us today is a new addition to the Headway Wealth team, Chief Investment Officer, Chris Wheatley. Thank you for joining us today, Chris.
Thank you for having me.
Quite a volatile year so far in the markets, so it's a really handy time to have you. You joined us at the start of April, right in the middle of a war. What are the major themes at the minute shaping the markets across the world?
So there's two things that are really going on, and you can look at it from a bond investor's point of view or an equity investor's point of view. So the bond market is close to all-time high yield since 2007. So the US has just issued a 30-year bond at over 5% for the first time since before the global financial crisis. So bond investors are screaming, inflation is coming, inflation is coming. And equity investors are going, hey guys, it's completely okay. AI is going to save the world. So at the moment, we're seeing the S&P hitting new highs. Markets seem to be okay. So that's sort of the dichotomy of what's going on at the moment. So is it going to be an inflationary world, or is it going to be an AI saves the world? It could do both, but it feels as though there is a potential for a disconnect to happen and for either the bond yields to snap back and come down, or for equities to sort of have an end to the rally that we're seeing at the moment.
Okay. Is it due an end to the rally, do you think?
Asking me to time the markets is the $1 million question, Hamzah. I think if I could do that, I'd be sitting on an island and not chatting to you, but I tease, of course. The likelihood is that the rally will run out of steam. The thing that can keep it going is US earnings. And that's the key thing to watch for is US earnings for the big tech companies like NVIDIA. We can say NVIDIA had amazing earnings and market's going to continue to rally. And then you also have the ability of the US consumer to keep on funding purchases of just products in general. The risk to that second story is the Strait of Hormuz is not just an oil story, it's a plastic story as well. Oil goes into a lot of things that we consume, not just into our cars and into our sort of boilers, etc. If there continues to be a supply choke, then potentially there's a plastic shortage, which means that people stop being able to consume as much because there's less stuff being produced.
Interesting. So how long has that choke been on now, roughly?
So I joined at the start of April. That was kind of the worst point of it for markets in terms of equity markets. But if we say that there's been 2 months, realistically, of there being a tight oil market, we'll probably see that impact in the next 4 to 6 months. If we had a scenario where the Strait opened today and everything resumed to normality, we expect normal conditions, so pre-Trump dropping bombs in Iran conditions, probably in up to a year. So there's definitely going to be some impact. The hope is that it can be mitigated and it's only a short blip as opposed to something more fundamentally breaking within the way that oil markets operate.
So do you think the main driver to the equity markets at the minute has been AI?
100%. There is some more breadth coming into the market that we can see. So by that, I mean, it's not just the big, if you remember a few years ago, they were called the FAMAG stocks. So it's not just the market leaders that are now driving the S&P and the broader US market. We're seeing some other names start to crop up. However, on the flip side, you're seeing a lot of SaaS companies like Monday.com. I know that we can't get into specific stocks here perhaps, but there's a lot of SaaS businesses that are being sold off quite heavily. So, I mean, to the tune of 60, 70% over the past 12 months. The sort of sword of Damocles here is that AI is going to come in and is going to make a lot of more companies very efficient. It's going to help a lot of people build their own tools, their own AI agents, which makes them more efficient and reduces the cost burden of companies in general. But then those companies that are providing things like CRM systems, Monday.com, are selling off on the back of that. So it is really an AI story, whether it's good or bad.
Interesting. I mean, seeing a lot of different AI companies that have come into the market over the last 2 years, something I've noticed is that from speaking to founders of these businesses, they are really starting to see a lot of fruits from their labor over the last couple of years. But people are now subscribing to these AI tools, not just the big stocks like the NVIDIAs and obviously everybody talks about ChatGPT. We can't get through a sentence without using it, but a lot of other AI tools within different industries that are streamlining businesses. And I'm noticing a lot more than just those big names are starting to make huge revenues out of AI. People are subscribing to it. We're subscribing to it. to make business easier for us. So I think hopefully it does actually bring a lot of other businesses into the markets that'll be interesting as well.
Yeah, I think you'll definitely see two things happening now within that space in particular. One is obviously when there's a IPO of someone like ChatGPT or Anthropic, which is the Claude owner. They are looking to IPO at some point this year or next year. That's sort of the schedule. There'll be big $1 trillion IPOs. But there's going to be a large number of much smaller IPOs coming from exactly those sorts of providers that do small parts of the market, but are AI enablers that can become quite interesting, and means that the hope is that over the past 15 years to 20 years, you've seen the number of publicly traded stocks fall in US, UK, European markets, that the IPO market can start up again as you get much more AI tech names, but there's a greater number of companies to invest in now. So more diversification than just having whatever it becomes, 60 to 70% of the market in the sort of just a tech enabled name.
What do you think is the biggest risk to AI?
Gosh, I think two things. One is a sentiment driven and one is a real world implication. So from a sentiment point of view, if you start to see earnings be a little less good than people think, the shares of AI related stocks are going to sell off quite a lot. They've enjoyed a really good run. People will take profit. That's just the natural market cycle. I wouldn't say that is a systemic risk though to them, and that those companies won't continue to do well in the future. It's just a little bit of steam taken out. A real world implication becomes the ability to get AI data centers up and running in order to satisfy the demand that we need and we sort of in general we want. And the real world impact of that is, what is your power source? Are you able to get cheap electricity there? Are you able to get sufficient chips? Though those things can disrupt the story, as can a decision by a big government, say the US, for example, to tap the brakes on AI. If there becomes a bit of a concern around the future of where AI is taking us as a society, the US decides to slow down a little bit, that could impact the stocks that we've seen do so well.
And you've just touched there on the risk to society. Explain a little bit more what you mean by that.
So someone I quite respect, I won't mention his name to spare his blushes, but he said, if you could imagine going back 100 years when you had automation come in, you replaced a human's physical power, their ability to dig a ditch or to farm land, and you made it much more efficient. That replaced a huge amount of labor, physical labor, but we still had intellectual labor, the ability for white collar work to be done, to think, to process, to articulate, and that created a whole service economy. AI is going to replace the service economy, or at least that's the threat. It's replacing that intellectual labor. So what are you going to do, or what are humans going to do when no one's digging ditches because you have a JCB that does it? No one is drafting legal memos because AI is doing that. So that becomes the issue with what do we do because AI is taking jobs in effect. And yeah, physical too. I mean, there's a phenomenal research piece which was half written as a blue sky thinking, half written as this is what we think could happen. It came out last year, I think around this time. It must have been April or May. It's called AI 2027. And I think you definitely go away and read it. And what it does, it lays out a timeline of the evolution of AI over the next few years to the end of 2027. It talks about its impact at a governmental level, defense level, a societal level. And it's written by senior researchers within OpenAI. And it paints quite a sort of maybe a great view for humanity, but also quite a scary view as well. And effectively, it comes down to when AI decides that it doesn't need human labor anymore, it can create machines itself, and machines are more pliable than humans. It then replaces humans after a time. So to that point on whether it replaces physical labor too, it could do that. So the positive news is if you could imagine a world where what do we want as humans? We've talked about this a lot, Hamzah, you and I, and also Elliot and Duncan too. It's spending time with family and doing things that mean more to you than just sitting in an office or working or having a set of 9 to 5 days. So AI gives us the ability to work more efficiently so that we can actually have more time with our families. And if you are a long-term investor and you've got a portfolio that is exposed to US tech and is exposed to other things as part of it, you should stand to benefit from the growth in AI, as well as have that extra time with family, with friends. It means you can stop working an hour earlier because you've got something going on in the background that's whirring away and making and drafting things for you, and you get to do bath time. That works out quite well.
If you want to do bath time.
If you do not want to do bath time,
I would say 5 or 6 days of the week is good. A day off from it now and again is great. But I do miss it when I don't have it. Let's talk about UK growth concerns. I think we've had a good couple of years from the UK. Do we have any growth concerns around the UK? Obviously, politically, things aren't looking great at the minute. There's a lot of things happening in Parliament. What are the main concerns we've got at the minute in the UK?
So it's a great question. The main concerns are what's going on in Parliament at the moment. So talking about the Labour leadership issue, what is the filtration of that through the economy? So realistically, the Conservatives kicked this off a couple of years ago when they decided that they didn't like wealthy people and they were going to change the tax laws that changed it from being about domicile to residency. So we've seen lots of wealthy families, and not the wealthiest, but just wealthy families in general, move to places like Dubai, places around Europe where it's a bit more sunny than sometimes it is in Durham and London, etc. And that's taken a lot of jobs, but also a lot of capital away. So there's less investment going into the UK. There's less tax dollars that are coming back into the UK too, or tax pounds that are coming back into the UK. So the government has a weaker fiscal position to invest in general. It's trying to combat that by creating things such as a bit like the Nordics have, is a sort of a supernatural fund that can invest into growthy projects. There was recently a really good Sunday Times article with the guy that runs that fund and saying, I want you to pitch me your ideas so I can invest them or not. So you've got sort of that sort of growth aspect of it, and the lack of tax sort of pounds coming into it. But there's also an element of what is Labour doing for small businesses, as opposed to just that macro point of view. It's creating a harder business environment for a lot of small businesses who are spending much more of their revenues on wages, who are spending more revenues on red tape. So at that point, can those companies continue to grow and still be the backbone of the country? Maybe not. With the Russia-Ukraine invasion that we had back in 2022, a lot of people were talking about this is a great example of why we need to cut a dependency on oil and natural gas. And there has been a shift, but I think ultimately it comes back down to the investment cycles into things like solar or wind is quite long. And you also are finding the biggest problem with solar as an investor was that there were so many gains being made in the technology that you had a contract to produce X amount of energy. You knew it would cost you 1 billion, I'm making up the numbers, and you would get 1.2 billion of revenue for it. So it worked out. But then within the 3 years it's taken you to build that sort of solar panel farm, the technology shifted where it's now much cheaper. So you're very uncompetitive at the prices you're charging for the delivery of your energy. Whereas oil is just oil, it's sort of just there. And I don't think that there's a huge amount of renewable energy projects that are coming on the back of this. But I was chatting to a family the other day who said actually what they're finding is that there's a big opportunity in uranium at the moment, because a lot of uranium is produced in the Middle East and it needs to go through that conflict zone in order to reach the US and other parts of the world. And actually the uranium markets hadn't caught up to that fact. So a bit like we saw with gold and copper, where we knew that there was this big deficit of supply coming and still a big demand, that there had to be a big price spike. People are looking at that market going, well, there's this big disconnect and potentially there's a chance to make money off the back of that.
So with the way the markets are at the minute, anything in particular you would be watching out for? What would be the advice you would be giving people at the minute when it comes to portfolio rebalancing and stuff like that?
So recently we had this discussion in the office and talking about what is normal for markets. And it's very normal for markets to have drawdowns of 14 to 15% a year and still end up the year positively. We saw a drawdown of, I think it was 6 or 7% in broad portfolios in April. So from here, we could see a further fall in markets, but actually that's okay. It's all part of the normal cycle. And actually the wall of worry to invest in equities is quite high. There's a lot of reasons why you won't invest in equities. Geopolitical concerns have always been there. You've always had concerns over commodity prices, the valuation of business. I remember back in 2013, 14, 15, the price earnings ratio of the S&P 500 was 15, 16 times, which seems incredibly cheap compared to the 22 times now. But in actual fact, back then it was at 10-year highs for expensiveness. So there's always a reason not to invest, but actually the thing that's paid the most is by being a long-term investor, just saying, hey, we're going to stay in equities. If there's a pullback in markets, we're going to use this time to reallocate and rebalance into equities. If there's some cash on the sidelines, we can put this in. And also I'd say in general, for a lot of people, they are earning cash and income and dividends through their careers or other assets consistently. So if you do have cash and you can deploy it into markets, even though it might be scary, it over the long term, over 30 years or so, it always is the right decision to make.
So no emotional decisions, keep working on logic.
Keep working on logic. It's really hard. And I don't know if you guys find this as well, but often when I make a decision for my own portfolio, I sweat about it for a few days because of the emotional baggage that it carries, and you have to try and turn that bit off. And so having someone who can be that one step removed and understand the emotion you're going through, but say, well, actually, this is the best decision. Don't worry about it. And if you are concerned, I suppose it's do things in halves. So do half now and then say in 3 months' time, I'm going to do the rest of it. If the market's fallen, then you feel a bit good about your decision to do half. If it hasn't and it's further up, no, that's okay. I've still made some money.